Good morning, good afternoon, depending on what time zone you might fall in. My name is Jason Paff. I'm from thedutchbook.com. Thanks so much for each of you joining us and investing in your own trading education. Appreciate you being a part of this, letting me share some of what I've learned, and hopefully through your engagement and questions, you can share some thoughts, ideas, and feedback with me. Please feel free to email me after the broadcast if you'd like to connect, if you had some additional questions, some additional follow-up, or maybe even a future webinar topic you'd like, or an article. I publish articles 3 to 4 times a week under the market news section of the Nadex website. So my email address is jason, J-A-S-O-N, @thedutchbook.com. Feel free to drop me a line and just send me some feedback, your thoughts and ideas, and we'll continue the conversation. So thanks for joining us today. This is part 2 of a 2-part series we did on technical indicators. Part 1, we just went through the content and defined 5 common and popular technical indicators for technical trading. Today we're going to review that content. This was a few weeks ago, so what I encourage the folks who are part of that session to do is to go out and practice. Go to your Nadex demo account. If you haven't registered for a Nadex demo account, you can go to nadex.com/demo, register for a free and permanent account. It takes 30 seconds. Try out some strategies, try some indicators, see what works for you. And then the idea is here in part 2, come back and I'll look at some charts live. We'll put some indicators together. Again, this is an overview. We're not going to go deep on any particular indicator, but we'll take the content we went through last time, review it. So if you weren't a part of the webinar last time, no worries. We'll catch you right up. And then we'll look at some live charting, live analysis as I share my screen and look at some indicators that we talk about, and I'll let you know what I'm seeing. So just to introduce myself, again, my name is Jason from thedutchbook.com. You can find me on Twitter at JMPFAFF, or as I said, email me, jason@thedutchbook.com. Really, my approach is 3-part. I've been trading forex for over 10+ years, digital currency, Bitcoin for 3+ years. Huge fan of Nadex, and I assume as you being a part of this webinar, you're familiar with, or maybe you love to trade Nadex as well. We look at fundamentals, we look at technicals, and we also look at quantitative data. So what I typically will use technical indicators for is to help look at risk, size trades, time, entries, exits. And one angle I particularly really like to glean from a technical indicator is a look at momentum and trends. And how is the trend picking up? Is the trend turning? Is it accelerating to the downside? And we'll look at some indicators today that can help us quantify that, or at least give us a preview. Before we get started too in depth, certainly want to take up the Nadex risk disclaimer. Please take a few seconds here to read it on your own. A few things I'd just like to point out as we look at this. This webinar today is for information and educational purposes only. Certainly no solicitation or trade recommendations of any kind on today's broadcast. We may look at past performance and historical data. In no way should that be considered indicative of future results. Nadex contracts certainly representative of underlying asset classes, and you trade on the price of those underlying markets in Nadex, but not actually the assets themselves. And as with all trading on any platform can be volatile, there's certainly risk involved. So please understand your own risk tolerance and your own level of volatility you're looking for before ever trading a financial instrument. All right, so let's get started. So just to recap, again, the last time we talked about this, certainly to catch up anybody, if this is your first webinar, welcome. Love the fact you're with us, investing in your own skill set and education. There's a few assumptions that form the basis of technical analysis. Basically, to believe that there's value in technical analysis, you need to subscribe to a few assumptions. One is it's based on the assumption that the market might move in certain patterns. that there's a method to the madness at times, so to speak. Certainly in my case, I understand that the markets are really a collection of people, traders who are coming together to form an opinion on the price of an asset, and over time, depending on the factors and circumstances, their behavior, in my opinion, certainly can form patterns. The second assumption is that those patterns might repeat. You would need to see it in the past and then be able to extrapolate that potentially to a future scenario for it to have any value. As a trader, we're not historians, right? It's one thing to understand the past, but your assumption, if you're trading from a technical perspective, is that those patterns that you detect in the historical data, or that the indicator detects in the historical data, might repeat in the future. It certainly doesn't always happen that way, which brings us to the next concept. It takes some discipline and experimentation to trade from a technical perspective successfully. I encourage everyone on this call and all traders that I have the privilege of interacting with, it really takes a balanced mindset. There are going to be profits, there's going to be losses. You need to be able to do your homework. Certainly, you need to love what you do as a trader to keep you going through the good times and bad. And it does take work and study and research and more study and practice and more study to really understand and be able to use technical indicators successfully. I don't believe, based on my time in markets, that I'll ever learn enough or ever learn anything, that all that there is to learn. So a love of learning, a spirit and an energy about what you do, and a curiosity about why some trades work and others don't is certainly important. And then the discipline and experimentation, as I said, really lays on top of that. Discipline means, when you set out as a trader and you understand your risk tolerance and you build a trading plan or a strategy, the discipline to stick to it. The other is experimentation. And that's where I really, again, recommend the nadex.com/demo. Demo account takes you 30 seconds to sign up, but you can go in there. It's free and permanent, and try out the different strategies that we may touch on today. So in terms of technical trading, and a lot of this works if you're trading fundamentally or price action as well, I always like to ask traders, before we jump to the data and the technical charts and the indicators and the flashing lines, et cetera, what are the things that we need to stay mindful of as people, as traders, as humans, to help us from a mental perspective, to gain a mental edge and win the mental game as a technical trader. So the first thing is to know that the technicals, and this is specific to technical trading, it's about a lot more than direction. One of the things that is really important, especially if you're a newer trader, it's very easy to get to a place where you're only concerned with or only thinking about the direction, and you're trying to call the shot and see which way the direction of the market is going to go, and then you want to place a trade and follow it there, so to speak. But there's a lot more to technical indicators, and there's a lot more to trading than that. So you can use technical indicators to size your trades, measure your risk reward, and then select your entry and exits. You may know that it's going up, but you also want to understand, and we'll talk about this with average true range, so to speak, how much, based on prior history, can it go up? Where might a good exit point be? I might have the direction right, but I'll also need to know an entry or an exit. In addition to, again, helping you just understand risk reward and position sizing, et cetera. Something else to stay mindful of, continue to ask good questions. Remember, an indicator can only give you the information that you're looking for. The first mover in that equation really is you. So understanding why you need to use certain indicators and why certain things might be important is absolutely critical to being a successful technical indicator. The indicators can only answer the questions that you ask. Number three, stay balanced. You definitely want to strike a balance between only looking for data to confirm your bias, and on the other end of the spectrum, just simply blindly following what the data or the technical indicator says. I encourage folks to stay right between. You should have an opinion and an outlook and a point of view, but if the data and the indicators are telling you something different, it definitely behooves you to understand why, to look into it more, and maybe pull in a few other indicators to round out your point of view. Keep it simple. This is a huge area of opportunity, again, especially for newer traders. If you're using an indicator and maybe you're using 5 or 6, you should always be able to explain a trade in 1 sentence or less. If you can't, you've got to learn more, keep breaking it down, keep studying, and keep understanding it. Just because an indicator is telling you something and you know that if it flashes a certain color or a line turns in a certain direction, you're supposed to place a trade, that's great, but understanding why is really how you get better as a trader. Practice, we've talked about that a few times. Check out the demo account, work with different strategies, again, learn why some do and don't work, and continue to refine your craft. And then lastly, again, stay positive. You know, not every trade is going to work out. We're all wrong sometimes. I'm wrong about something every day. Use it as a learning opportunity. Don't let it impact the next trade, but find out, you know, why it might not have worked, and find out where maybe you can make an improvement for next time. All right, so now that we're balanced and positive, let's take a look at our 5 key indicators. And again, really the agenda here for the rest of our time today is we're going to recap real briefly the content, or a quick explanation and a definition of each indicator, and then we'll look at some live charting, and I'll put up and share my screen, and we'll look at some live indicators and just see what they're telling us, and we'll look at some historical trending and how they interacted with the indicators, and we'll go through each one. So the first is moving averages, probably the most common technical indicator, and moving averages also are a part of other technical indicators, and you'll see that as we work through our content. These are trend following, lagging indicators. They're based purely on past price movements. A moving average will help filter out the tick-by-tick noise and give you a more clean, smooth representation of the overall direction and shape of a market based on the time frame that you select for your moving average. 2 most popular versions is an SMA, a simple moving average, and an EMA, which is an exponential moving average. The basic difference is when you put in your time period, or when you look at a certain time period on a moving average, simple moving average treats every price point that you tell your chart you want the same, and exponential moving average weights more recent values more, and you'll see that here in a second on a chart. A couple of highlights here. Some of the common time frames folks look at are a 9-day, 26-day, 50, and 200-day moving average. Certainly if you're trading in a shorter time horizon, you'll want to, I would recommend a shorter time frame on your moving averages. If you're trading a daily or a weekly Nadex contract, for instance, you might want to look at much shorter time horizons on your moving averages. Again, we talked about the simple moving average. If you're doing a 9-day simple moving average, it'll just be the average for the last 9 days. If it's an exponential moving average, it'll weight the last couple of days more strongly. So in terms of the signals, a rising moving average indicates an uptrend. Declining moving average logically follows, indicates a downtrend. However, one of the signals or confirmation signals you can use with moving averages is to use 2 different lines, measuring 2 different time periods. And when you have a shorter term crossover a longer term, that typically indicates, a confirmation of a move in a certain direction. Upward momentum confirmed, for instance, when a shorter term moving average crosses over a longer term. So let's take a look, and I'm putting up, see a gold, this is gold. And I've got 3 different moving averages here. The white line is a 50-day moving average, simple moving average, which as you now know is just the sum and average of the past 50 days. The blue line is the 200-day, and then the pink line is the 50-day exponential moving average. So one of the first things I want to point out is we talked about exponential weighting near-term values more heavily. You can see here where the pink line, as the price of gold futures heads down here lately, and gold is definitely moving down, at least it has in the last few sessions here. You can see how the pink line is inside of the white line, meaning it's a lower value, meaning it's tracking more closely the near-term price of the gold contract. The longer-term moving average is above all of those, as you know, we've had higher price points here in the last 200 days that is pulling that moving average up. So one of the first things to point out here, I'm circling this. So let's look at our simple moving average of our 50-day and our 200-day. Again, the 50-day is white, the 200-day is blue. So when you have a 50-day cross under a 200-day, that is what's known as a vaunted death cross. So if you've heard that term before, some of you may be familiar with it, some of you may not, or some of you may have heard it and not exactly know what it means. This is when a shorter term moving average crosses under a longer term moving average. Again, typically, if you're watching, you know, a popular financial program on television, they talk about a death cross. Odds are they're talking about a 50-day crossing under a 200-day. And that is typically thought of as a bearish indicator. And you can see in this case, from the time, you know, right when we had the death cross, yes, we had a recent move down, sideways to upward grind as the contract tried to recover, gold futures tried to recover, death cross, and it headed back down. One of the more important things I like to mention to folks is, you know, because there's a lot of debate, right? How much should you weight certain indicators? The thing to remember about the death cross when you're talking about a 50 and a 200 and something as widely traded as gold, whether or not you believe it has predictive power, there's a lot of folks who do, or a lot of folks who will trade on that. And so it's very important, whether or not you believe you have conviction and you're interested in placing a trade, whether or not that's the case, there's folks who do. There's folks who track those things very carefully, and that certainly informs their sentiment. And so I would say, certainly as we are here at this level on gold, when it went under and we crossed and had a death cross, that certainly provided very bearish sentiment for folks. Let's look at Bitcoin. So this is interesting here, and you'll see this with different instruments. So with Bitcoin, remember the blue line is still your 200. You can have moving averages from a technical perspective form support and resistance. So support defined as you've got a level above that an asset has a hard time breaking above. Excuse me, that's resistance. Support would be underneath you or underneath the price of the asset when it drops to something and bounces off. Here in the case of Bitcoin, if we look at a 200-day moving average, you can see, and I've circled there on the chart, in a couple of cases, we've got the 200 serving as resistance, meaning Bitcoin had a hard time breaking up above that level. So that's one way, again, to track, and you'll want to take a look at different assets and see if they behave like that. But that's definitely a case where the 200 acted as resistance for Bitcoin. Here's a case where the shorter term moving average was acting as support. So I'm circling on the left side of the chart some cases where you've got your 50-day moving averages, and Bitcoin is bouncing off of those, right? And so in those cases, the moving average, the shorter term moving average acted as support. The asset, the instrument dropped to that level and it bounced above. All right. Let's get back to our deck. Let's look at moving averages. So average true range. Switching gears, new indicator. Average true range is really important, in my opinion, but I think many folks who've traded Nadex for some time would agree. It's a simple indicator, but one that's important if you are trading options, certainly binary options, spreads. It's something that I think is an important indicator to understand and know. And as you get fluency and familiarity with it, you can decide how it works best for you. But to understand the average true range, I believe, is important when you're trading really any asset with a fixed time duration, and in the options scenario where you've got different strikes, you're trying to get above or below, or you've got floors and ceilings like in a spread product. So average true range is not going to indicate direction or trending. Like we said earlier, a lot of your best indicators don't exactly provide a look at direction or momentum. Even as a new trader, you're really focused on that. This is an important measure of volatility in that it'll show you, based on historicals, based on prior patterns, prior history, for whatever period you select, it'll show you how much, what type of range, the average true range that that asset has traveled. It's a simple calculation, really. As you're getting to know it, all you really need to know is that it's based on recent highs and lows and closes. So a high is obviously the maximum price during a session, the low is the lowest price during the session, and the close is where it finishes a session. So ATR consists of the current high, the current low, and then the absolute value of the current high minus the previous close, and then the absolute value of the current low less the previous close. Again, that's a lot simpler if you just know it's highs and lows and closes. It's really a moving average of the range that the asset travels is the easiest way to think about it. A wide and increasing ATR, average true range is often shortened ATR, indicates high volatility. It also, again, as a spread or options trader on the Nadex platform, tells you, based on historicals, how much that asset can move based on the time frame that you're charting. So let's look at ATR here. Let's go back to, let's go to Bitcoin. We'll stay with Bitcoin for a second. So average true range, again, is really simple. It's just going to be a moving average of how far that your asset can travel. There's a lot that you can do with it. But again, my goal really today is just to help you gain some familiarity, and then you can, as you work through some different strategies on your demo account with Nadex, nadex.com/demo. You can experiment with how you want to use it. So I'm going to expand this window here a little bit. So the y-axis gives you a dollar amount. That's your range, right? That'll tell you, again, for that time period, how much the asset can move. In this case, I'm on a daily chart, so this is on a daily basis. So Bitcoin is a really interesting instrument to look at here. So we've had a true range of almost $2,000. If you're familiar with Bitcoin, and I suspect many of you are, once upon a time when we were up pushing almost 20,000, the price would move as much as 2,000 a day, or up to. That's again a moving average of that time period. Interestingly enough, for Bitcoin, that range widening, that volatility correlated with higher price, and again, in hindsight, that makes sense because it was just going up and up and up a lot and kept going up each day. It doesn't always happen that way, but in the case of Bitcoin, it did. And now we see that the true range collapses down to a level of, a little less than $400. So what this is saying is, and right now we're on a 14 period, or in my case, because I'm charting on a daily basis, a 14-day moving average of the range of the asset. It has moved up a little bit from, let's see, that's about July 13th. So the moving average is moving higher, telling me that the range is increasing, right? So on ATR, if I'm placing a trade, and let's say I'm trading daily, I would know that that asset could move based on historicals, you know, an average of about $400. If I change my time period to weekly, you can see that it's about $1,300 on a weekly basis. And you can see as I widen the time frame, it gets less volatile or less of a larger move. So it's really important as a technician and a technical trader, you're careful with the time frames that you select. But if you're trading a, let's say a monthly contract with Nadex, and you want to know on a weekly basis what your potential exposure with respect to a range, you want to chart that weekly. But then let's say you're calculating an entry and an exit, and you want to know how exposed you potentially are to a potential move above or below the floor or the ceiling, for instance. You want to switch back to a daily to understand, but you can even compress that down. So you want to know in an hour, we're trending right at about, a range of 70 on an hourly basis for Bitcoin. So average true range gives you a sense of the volatility. Again, volatility defined as disagreement in the market over the price of an asset, and as the price moves back and forth, and traders try to decide on the value of that asset. The more movement it is means the more disagreement, which means the more volatile the asset, which means in an average true range sense, the wider that your asset can move. However, if we go back to our good friend gold futures, I think you'll see, we're on a daily, and gold's at 12 in terms of average true range. Not a lot of movement there when you compare it to Bitcoin, right? You could take a nap with Bitcoin and it'll move 70 to $100, depending on the length of your nap, of course. But in the case of gold, you could go a week, let's say, and hibernate, and you might get a range of 25, right? So as you move back, one of the things I love about the Nadex platform is all the different markets on the platform and the different time horizons, right? You can do a 5-minute binary, or a weekly contract, a daily contract, or you can do a weekly contract but enter and exit throughout the week. It's really critical that you understand the ranges as you move through those different time frames, and ATR is a great way to gain context on that and to understand that. All right, MACD. This is moving average convergence divergence, MACD. This is a trend following momentum indicator. So it's going to show the relationship between two different moving averages. So we talked about moving averages earlier. Now we're going to show the relationship of two special moving averages developed just for MACD. And we're also going to talk about the distance between those moving averages being a measure of the momentum or strength of a trend. So it's calculated by subtracting a 26-day exponential moving average from a 12-day exponential moving average. That's your MACD line. And then your 9-day exponential moving average of the MACD is called the signal line. And you'll have some crossovers, and we'll look at this again live here in a second, which can, if you are so inclined, potentially serve as, for some folks, a buy signal or a sell signal, or at least an indication that a trend has reversed and is moving in a different direction, and that may be a buying or an entry opportunity. So as we said, MACD, it's really two different exponential moving averages. You're going to have those lines, and then you're really looking for two different things as you watch those lines. One is the distance, and that's an indication of the strength of the trend. The second is just the crossovers. When they cross over, it indicates a new trend. So it's really, you're looking for a crossover, and then you're looking for a widening gap once they cross over on MACD. You'll also typically, depending on your charting program, see a histogram on MACD, which that's where the measurement of the distance between the two lines really comes into play. So let's look at our good friend MACD. And I will pull that up. We'll stay with gold futures here for a second. All right. So the orange line is the signal line, and the blue line is the MACD line. So what you're looking for here is a crossover in an uptrend. That'll be a crossover of the MACD above the signal line. And then the pink is the histogram I was talking about, where that'll, you know, the wider the divergence between the two, the stronger the trend. So we can see in this case, right here, we have a crossover. And one thing I'll ask each of you to do is, you know, just imagine in real time, right? We are here on January 25th, and we've got a good crossover that develops into a nice wide, I call it a stegosaurus pattern, but that's a nice wide, I've never heard anyone else call it that before, so if you say that, people look at you crazy. Yeah, it's a nice wide divergence between the two lines. It shows you a strong trend. And then you see that crossover happen right here, which is right here on our candles. Don't quite have that lined up. Okay, so draw arrows here. So right here on 12/28, it's actually 1/4 right after the weekend, and right after New Year's. Coming back from New Year's, looking at your MACD, you're a dedicated trader. So, you know what? I'm on a weekly. Let's narrow this down to a daily. See how easy it is to get caught up in your time frames. All right. Now we're on a daily. All right. So this will change things a little bit here, but that's all right. All right. So this looks to be about the 18th. Let's get this synced up. The 18th. Man, we are shopping for the holidays here and taking a look at our MACD. So we had a crossover followed by a nice wide histogram. You can see also here, it was an early indicator, I'd say, of what ended up to be a pretty sizable uptrend, right? If you can see that kind of come together, let's measure it here. So from right here, where we saw the crossover, you know, we got a nice 7.5% move, which in the world of gold, 7.5% in 38 days is actually pretty significant. So that's nice. Now, on the way down, what you're looking for is for your signal line to cross back under the MACD line, which would be the opposite of what we just had. So, let's see, let's go to Bitcoin here. Excuse me, your did I say that right? Your signal line, yeah, to cross under, or your MACD line to cross under your signal line. I think I said that backwards. So let's look at this. All right, we're back with Bitcoin. This will bring in our earlier indicators. So right here, about the 4th of May, we bumped up against resistance on our moving average. Remember, we looked at that just a second ago. And we also have a cross under on our MACD. So now it's a situation where we've got one technical indicator, we're bumping up against the moving average. We've got a cross under our MACD. Not the widest pattern you'll ever get on the histogram, but still material. There's some divergence there. And you can see our trend, as we discussed earlier, certainly down as we bounced off resistance. Right? And then we have a cross under on our MACD. So as a trader, you'd see both of those come together, and they came together both right about here. The MACD was just a bit later, and then you see we have a pretty steep downtrend coming off of that. And if you just took the downtrend to right here, where the MACD comes back around, see that's a 30% move, right? Again, these are historicals. This is no indication that at any point this will be something you could extrapolate with respect to a percentage move. But I think in this case, as a new trader, or maybe an experienced trader just looking to fold these indicators in, you're trading Bitcoin, you see a bounce off resistance, you see your MACD line cross under, and it results in a potential 30% move in this case. Again, Bitcoin was also north of like 10,000 here. So I think that's a good opportunity there to see those two come together. All right, keep moving on. RSI, I love RSI. This is an indicator I use often. This is another measure of momentum. It'll compare the magnitude of recent gains and recent losses over the time frame that really you specify. It'll measure the speed or the velocity with which the market is changing direction. Typically, the two terms that you'll hear a lot with RSI are overbought or oversold. Overbought is typically above 70. Some folks will tune it to above 80. Let's just, for our purposes today, call it above 70. That's an overbought situation, meaning potentially folks have piled into that trade. It's reaching a level of exhaustion. It could be overbought and preparing to reverse. Oversold, the opposite. A lot of folks have sold that asset or that instrument, sold that trade, and that could be reaching a level of exhaustion and preparing to turn. So your keys with RSI really are that the 70 level on the high side and the 30 level on the low side. When you see the line move above 70, could be indicating overbought. When you see it move below 30, could indicate oversold. And again, sometimes folks talk about 80-20 and overbought, oversold. It really becomes personal preference and your own experience with measuring a particular market you may be interested in. All right, so let's look at RSI. And the thing about RSI is that I love, honestly, is it's simple. And it's good for context. And that's how I use it. I can't say I jump in and out of trades based solely on RSI. But as I'm scanning markets, and again, as we talked about earlier, on the Nadex platform, you've got so many opportunities to trade so many different markets, different time horizons. It's very exciting. And when you're using something simple like RSI and moving averages, for instance, as context, it allows you to scan those markets quickly and just get a quick snapshot glimpse, really, of where you are or where the market is. All right. So as much as it pains me, I will take out our friend MACD, and let's just look at RSI. Again, we're still on Bitcoin here. We can change it up and look at a different market here in a second. So let's look at Bitcoin recently. This is late, let's say July, just in the last week or so. Again, we see this here, just hit the moving average. the 200-day, and on our RSI, you can see it's at, I have it set to 70, 70 being defined as overbought. See, we got a pop on the RSI above 70, we got a pop into our moving average, and you can see what followed here over the last week or so really is a brief down move in our friend Bitcoin. So again, about a 30%, 28% move. So let's go to gold futures. All right, here's a good one. So, whoops. All right, my lame attempt at a ellipse there. So we have a peak here, about 1346. And again, when we hit that 1346, our RSI popped, oversold, and then unfortunately, if you were long gold at that time, you can see we were indeed oversold, market moved down. So something to note is, you know, here's where we are live, right? Let's look at this. This is today. All right, so let's look at gold today. We are in a death cross situation. Gold certainly heading down. Trend line is down. Oops, lost our RSI there. Whoops, now we've got two going. All right. Okay, so again, this is where you've really got to use your intuition. We talked earlier about balance and using a variety of indicators and going out to nadex.com/demo and registering for your free and permanent demo account. So here, and again, I'm looking at today's values, but you always want to look at what's happened recently to gain some context. My things there bothering me. Let's just use an arrow. So you can see here, we had an oversold on the RSI. We did not have a similar move in price, right? Right here before July. The trend stayed down. Now within here, and these are daily, this is a daily chart, you can see, there was some bids that came in at some point. But if you're just trading solely on RSI and you see the oversold condition and you bought, you may have had a bump here to basically stay sideways, but you were overall in a downward channel. This is where I really encourage you as a new trader, and it's why I wanted to do 5 and not just, my favorite technical indicator or my favorite 2. There's certainly some I use more than others. But here in this case, if you just solely use RSI, you may have missed the fact that, hey, it's a death cross, that's potentially bearish. You may have gotten caught up in a downward trend. So that's where you would hopefully be using a variety of other indicators. As we look today, now my circle's working, we're getting to that oversold scenario again. However, and again, this is just solely my opinion, just looking at recent historicals, I've got 2 cases in the last month where we've popped oversold on the RSI and not had any move higher. So if I'm trading gold today, I'm certainly going to consider that as I see us hit into oversold here. Can't say that that moves in either direction, certainly no forward guidance here, but as a trader, I'll just want to take in that historical significance with the asset to understand how it interplays with the indicator. If you go back here, you certainly have a situation where you popped to oversold and you saw a strong move to oversold, and then you see definitely a strong move higher as well. So maybe there's something there that you notice where it needs to be a move of conviction, and these have been just dips barely. That's certainly to you as a trader to really, your time on the demo account, your own expertise, your own practice, you can really get those things down over time. Again, there's always going to be winning trades, always going to be losing trades, but the more you understand how each market works with each indicator, the better off you will be as a trader. All right, number 5. The wonderful world of stochastics. The stochastic oscillator is another momentum indicator. It will look conceptually similar to MACD and RSI in that you're tracking the movement of lines above and below a certain level. So what stochastic does, it's based on the theory that where the closing price falls based on the range of the security or the instrument that you're trading can influence or can be an indicator of its future movement. So if it closes, a close near the bottom of the range, for instance, is typically in the world of stochastics thought of as bearish. Whereas if it closes the session at the height of its range or close to the height of its range, it's thought of as a bullish indicator. Stochastics have been around for a long time, and I'm certainly one who appreciates that it's been around a long time, and it's something that a lot of folks use, a lot of folks subscribe to, and a lot of folks have used for a long time. So we're not going to get into the math here. Again, if you're curious about the math or some of the construction of some of these indicators, please email me, jason@thedutchbook.com. I'm also found on the market news section of the Nadex website, jason@thedutchbook.com. Send me an email. We'll talk stochastics calculations all day long. But really what you want to understand, is, at least as conceptually, is higher closes on the overall range is thought of as bullish. Lower closes on the overall range is typically thought of bearish. You're going to track the movement of the lines, and above and below a certain level, and that will give you an indication as to the overall price. All right, let's go back to our friend gold. Let's remove some of my handiwork here. This is getting busy. Thank you guys for joining us here. All right, you know what? Let's put in a couple of others that we've already looked at. We'll look at RSI at the same time. We can look at MACD at the same time, and we'll look at now stochastics. Burned by my unwillingness to pay more to my friends at TradingView. So we'll just close simple 50. All right, so let's look at gold. Gold futures. Find a good one here. All right. So what you're looking for in stochastics is where what's known as the K line. And in our case here, stochastics are at the bottom. I'll widen this window for just a second so you can get familiar. So the K line is blue, and they move closely together, so it may be hard to see, but just bear with me. The K line is blue, and the D line is orange. So in the case of stochastics, you want them moving above, moving higher if you're long and looking for a trend. There's the 80 level. In the case of stochastics, 20 is the important level on the downside. So what you're looking for is a situation where the K crosses through the D. I'm trying to narrow this down. Whoops, a stray arrow there now. All right. So here's a good one. So right here, and again, these move closely together. So please, on your favorite charting software, I'm using TradingView, experiment with this. But you can see the K crosses through the D here. You can see RSI starts to move higher. We move above the moving averages. And it's something we didn't talk a lot about, but it's also thought of as, we talked about the moving averages crossing over, but it's also a bullish indicator when the asset moves, if it's been trending below, here in the case of gold futures, certainly been trending below and moves higher. So for the same period here, let's bring up our friend MACD. All right. So you can see here this move right at the beginning of 2016. See the MACD line moving above, getting a little bit of widening of our range there. You can see the K line moving above the D line on our stochastics moving higher. You see we're moving above a moving average. We get a nice uptrend there in gold. The other thing that this confirmation provides is not only was this an uptrend, but clearly there's some sustainability there higher in gold. And when you see alignment like that in indicators, that's certainly, potentially, right, the case. I can't say that that happens, all the time, but it's certainly, if I'm technically, trading on a technical basis, when I see 3 and 4 indicators all the constellation of those 3 and 4 come into alignment, certainly gives me an opinion that that may be a trend that's developing that has some strength or some conviction. All right, take a look at one more market here. So we load up oil. Certainly loves to trade oil. Nadex is a great platform for trading on the underlying price of oil. So let's take a look and see where we've had some movement in oil. All right, so if we look here, we have oversold on our RSI. We have swing low situation here. We have our MACD line crossing above. Very exciting. And at the same time, on our stochastics, we have a nice move higher. The crossover as well. Not quite aligned, but close. So this is another good situation too, where you can use different indicators to help you kind of determine where things may or may not be headed. Because you can see we kind of had a choppy sideways move here in oil before the trend really materialized, and you can see how the different trends reacted to that. We were overbought. RSI continued to move up. It moved down, but it continued to stay above. Overbought. MACD bounced. Brief cross back under. You might have sold here, and you could buy back in and ride the rest of the trend up. And definitely some sharp moves here in the stochastics. It's interesting how they all move in a similar fashion, and how they all move at different points in similar fashions. All right, so taking a look at oil today, we are approaching, if we're just looking at RSI, potentially, based on the chart, an oversold situation. However, there is really no momentum on the MACD. and our RSI is pretty tepid. Not yet to oversold. But certainly headed south. So if I was purely trading based on these indicators, I would definitely, and we're looking at oil here, I would start with the RSI and see we're still, the middle of the RSI is a market that's looking for a trend. We're just below par there at 50. We're not yet to overbought or oversold. But if we look at, let's say, an hourly chart, you can see, let me delete this, it's blocking our view here. You see we're starting to get down to oversold on the hourly. Oil's dropped this morning. You can see how much it changes on a daily, or now on an hourly from the daily. And we're getting down into oversold territory for oil. So good look there at how the indicator changes over different time horizons, which certainly should be top of mind for you as a trader based on your level of risk, your trading plan, and what type of time horizon that you're looking at moving in and out of the markets. All right, I'm going to clip through. Appreciate all the questions that folks came in with. So if you've put a question in the box, I'm going to clip through those right now. Again, if we didn't have time to follow up today to the level you wanted some additional depth on your question, please email me, jason@thedutchbuck.com. Happy to go back and forth and continue the conversation. All right, just scanning through the questions here. So talking about momentum indicators, asking about momentum indicators, are those just merely tracking price action? And to some extent, yes, right? One of the things to understand about an indicator is its limitations. It can only react based on the data that it has, which is historical data, and it can only answer the questions you ask it. So if you're asking, a chart, for instance, about historical data, yes, or about what's happened in the past, it will only have that historical data to use. One of the key things that I like to use the technical indicators for, there's two things what I think you can use to combat that. One, because you're looking for signal, right? One is it does help you filter out the noise. As you're trading multiple markets, something like RSI, something like MACD, Stochastics moving averages, I like to use those to give me a quick snapshot of the market. Where is this market at? Where has it been? And what are the indicators telling me about the market? Price action could get very noisy. Moving average smooths that out. RSI tells you where the momentum is. MACD tells you how strong the trend is, etc. Stochastics give you a good signal as an entry point. So understanding what the unique spin on that tracking the price action phenomenon that each indicator provides is really important, because again, RSI, it's just going to track the price action, but it gives you a sense of the momentum that's been behind that price action, right? The MACD gives you a sense of the divergence between the moving averages in a real quick snapshot. You could get there in a few minutes yourself, but you can get it in a glance looking at MACD. So one of the most important things, and I'm really glad you asked the question about the technical indicators, is to understand its limitations. It can only react on the information that it has about the past, but it can give you the context as a trader that you need as you're moving through your day fluidly and quickly. All right. Does technical analysis have a big advantage over fundamental analysis? I would say no. Technical analysis is one tool set. I would humbly submit I try and employ both. You're talking about something like oil, for instance. I want to understand the supply and demand dynamics and bring that point of view to the market. If you are concerned about supply and think demand is increasing, that's a bullish outlook, and I'm just hypothetically speaking here. And if you see indicators that also come into congruence with that and give you a bullish view of that, hour, day, or week, I think that's a stronger position. So the way I would think about that is I wouldn't necessarily feel inclined to pick one or the other. As humans, we're always wired to jump to labels or categories. I would think of it more in terms of, acquire the skills that you feel comfortable with, the outlooks and the ways to use those skills that you feel comfortable with, and trade in the way that is, in line with your risk tolerance, your strategy, and the ways that make sense for you. The key is you've got to understand those different avenues before you can truly do that. I don't think one's better than the other. Your level of comfort and, your ability to feel like you're working towards being a successful trader, I think, is important. At the end of the day, if you just don't like reading through, fundamental information, then you're probably not going to be a good fundamental trader, and you probably shouldn't pursue that path, or you'll be out of trading quickly. On the flip side, if you're not really into hardcore heavy charting, you might not be a great technical trader. So I would pursue whatever path you feel like you're going to stick with. I'd add as many tools to your tool set as you can, and I would just see what works and move it forward. All right. A couple more questions here. Okay, so following up on kind of our price action versus a technical indicator. I think what we're getting at here is, momentum just so closely tracks price action that, if you have a bar, so you're in an uptrend and you have one bar that heads down, the momentum indicator starts to head down. And again, it's a tough scenario. It's why no system works perfectly, and it's why again I would humbly submit using a variety of indicators and understanding the abilities and limitations of each. I mean, there are ways that you can filter, and this is probably a good topic for part 3. There are ways you can filter out shorter term price movements from your indicators and keep the momentum indicator, what I would say is robust to the trend and not as responsive. That would be a little bit beyond the scope of this webinar. But you're using wave analysis, sine wave analysis. Those are built really to be responsive, but filter out some of the shorter term noise and stay robust to the overall trend. So great questions. Keep checking it back, and maybe we'll have a part 3 that will really go into depth on some of those. I'm going to put my email in the chat box as was requested, so that anybody can reach out. Would love to hear from you. Hopefully that came across. Jason@thedutchbook.com. Thanks to each of you. The one thing I share in times like this is, this is an investment in you and your trading skill set, and your desire and willingness to join us today is something to pat yourself on the back for. It is hard at times to trade. It's a lot of fun at times to trade, but the one thing that should remain constant is your learning curve and your pursuit of additional skills, knowledge, and expertise. So congratulations to you for pursuing that. It inspires me, and why I like to be a part of these, because seeing your effort, engagement, and enthusiasm in these types of webinars is exciting to me. So thanks to Nadex.com for sponsoring this. If you haven't already, register for your free and permanent demo account, nadex.com/demo. And good luck. Practice on your demo account some of the strategies we've talked about. Email me a question and we'll continue the conversation.